This is Chapter 5, Module 4, about different investing strategies. So an investment strategy is really a plan to help you achieve your financial and personal and investment goals, and really depends on your personal circumstances, okay, including things like your age, your risk tolerance, your overall goals, and the capital or the amount of money that you actually have. And all these factors can actually help you determine, the kind of investments that you choose to purchase, whether it be stocks or bonds, money market funds or real estate. But in this instance, and for the purpose of this course, we're going to stick to equity or stock investing. So different strategies could range from conservative to highly aggressive, as we've actually already discussed. And your investment strategy is really like your game plan, right? So it's very important that you find a strategy that's right for you and right for your personal objectives and for your personal life situation. As an example, a 28-year-old would have a very different strategy to a 60-year-old, right? A 28-year-old might prefer a lot more risk versus a 60-year-old who probably would be a little bit more conservative and risk averse. So when creating an investment strategy, it's very important to decipher exactly what you're trying to accomplish. Saying that you just want to make money or become wealthy is a good goal to have, but you need to try and keep it more realistic, okay? So, a better objective would be to say that you want to achieve 10 or 15% average annual return on your investment contributions over the next number of years, and you want to try and amass a total of 100,000 or 150 or 200,000 that'll be used for a deposit on a house or university for your kids or whatever it may be. So the more specific the objective, the better. And there's also a number of factors that go into choosing the right investment strategy that works best for you, okay? But before we touch on those factors, one thing to think about is whether you want to choose an active or a passive investing strategy. So active investing involves the frequent buying and selling of stocks. It's much more hands-on and involved. It's also much more stressful, okay? Whereas passive investing strategies, on the other hand, are focused on buying and holding investments for the long term, okay? Passive investing is also a lot less risky than market timing strategies, because you're not trying to pick the tops and bottoms of markets. You're just holding throughout a long period of time and being passive about holding your investments. It's also a good idea to, you could blend your portfolio with both active and passive investing. So you could have some long-term stocks in there and perhaps a few that you might want to be more active on, buy and sell them, as they trade higher and lower. Because, investment strategies, can really vary quite vastly. There isn't one size, fits all approach to investing, which means that there isn't one particular plan that works for everyone, okay? So this also means that you'll need to reevaluate and realign your strategy as you get older and as your circumstances change, as your financial situation and financial needs change. So let's take a look at this presentation that I prepared that runs through the various different types of investing strategies. The 6 different types of investment strategies. 1. Value investing. The principle behind value investing is simple. Buy stocks that are cheaper than they should be. Finding stocks that are underpriced takes a lot of research on the fundamentals of the underlying companies. And once you found them, it may take a few months or years for their price to rise. This buy and hold technique requires a patient investor who wants to keep their money invested for a few years. If you are planning on keeping your money invested in the stock market for a few years, then value investing is an excellent strategy choice. 2. Income investing. Income investing is also a great way to build wealth over time. Income investing involves buying securities that generally pay out regular dividends. We've already discussed dividends. Bonds are the best known type of fixed income security, but the category also includes dividend-paying stocks and other securities like exchange-traded funds, ETFs, mutual funds, and real estate investment trusts. But in this instance, equities or stocks that pay dividends, if you invest in those types of companies, that would be income investing. Fixed income investments provide a reliable income stream with minimal risk, and depending on the risk of the investors looking to take, should comprise at least a small portion of every investment strategy. High dividend paying stocks are an excellent way of seeking income on your investments. Growth investing. An investment strategy that focuses on capital appreciation. So we're looking for big share price growth. So we're looking for a stock to appreciate in value massively over a period of time because the company is in the growth phase of their business. Growth investors look for companies that have signs of above average growth, as I've just mentioned, through revenues and profits. Even if the share price appears expensive in terms of metrics such as the PE ratio. We've already gone through exactly what is a price to earnings ratio. A relatively riskier strategy, growth investing involves investing in smaller companies that have high potential for growth, but also includes investing in large cap stocks as well as emerging markets. Small cap investing. Small cap investing is for those looking to take on a little more risk in their portfolio and involves purchasing stock of small companies with smaller market capitalization, usually between 300 million and 2 billion US dollars. Those would be considered small cap companies. Small cap stocks often go unnoticed and as such can be appealing, whereas large cap stocks may have inflated prices as everyone knows and invests in them. If you think about a stock like Google, everyone pretty much knows Google and or invests in Google, but there are some really small developing new companies that are publicly traded that a lot of people don't know about, and therefore they will have a minimal number of investors, and therefore the stock price hasn't really gotten much traction, and there could be a lot of growth or appreciation in the stock price. Small cap stocks tend to have less attention on them because they carry higher risk, which some investors may choose to avoid, and institutional investors may have restrictions when it comes to investing in small cap companies. So some large investment companies, the likes of Fidelity or Wellington or BlackRock or the hundreds of others that are out there, have certain mandates, and within their mandate they may not be allowed to invest their assets or invest their capital in small cap companies because of the inherent risk that some of these small cap companies carry. Don't forget, not all small cap companies become bigger ones. A lot of them actually fail as businesses, unfortunately. So the trick is to find the good small cap companies that are growing, that will become larger companies over time. Socially responsible investing. This is another investing strategy. Okay, this is investing in stock of companies that are environmentally and socially friendly. In today's modern world, investors and the general public expect companies to maintain some social conscience. Another term for it is environmental, social, and governance, or ESG investing. So there are actually some specific ESG funds or ETFs that own only environmental, social, and governance-friendly stocks within the portfolio. Socially responsible investing can also be known as green or ethical investing, and is an investment strategy which seeks both financial return and social environmental good to bring about social change regarded as positive, such as a positive, sustainable, or social impact, such as solar or clean energy companies, and would typically exclude the likes of alcohol and or tobacco companies. Momentum investing. Momentum investing is a trading strategy in which investors buy securities that are rising and sell them when they look to have peaked. It's very difficult to tell when a stock or an overall market is peaking, but often when there's a lot of momentum behind an investment, it continues for a really long extended period of time. Momentum investing is a system of buying stocks or securities that have had high returns over the past few months or even years. Tesla would be a good example here. So there was a lot of momentum buying in Tesla over the past year or 2 years, and the stock really got going. So you kind of want to be with the momentum. You want to ride along and buy stocks that have a lot of momentum behind them, like Tesla as an example. Choose an investing strategy that is right for you. When choosing an investing strategy, always ask yourself the following questions. What is your investment horizon? Is it short-term, medium-term, or long-term? How much time do you have on your side? And this would involve your age as well. So if you're younger, you could say you have a lot of time, so you have a long investment horizon. If you're a bit older, you might have less time to reach your financial goals, and your investment horizon would be shorter. What returns are you seeking to achieve? So are you looking for really high returns, which would mean higher risk, or are you looking for more mediocre type returns, which would be less risk, and a lot of people are comfortable with that? What amount of risk are you willing to take? So as I've just said, are you happy and comfortable holding small cap, high growth companies, which are quite risky, or are you more risk averse and you'd rather hold dividend or income paying stocks? What do you plan on using invested funds for? So you need to figure out what is your investment strategy or objective. What do you need the money for? And if you need the money in the short term, you don't necessarily want to be tied up into high growth stocks that might take a long period of time for the companies to manifest and really reach their investment goals. So you need to ask yourself, what are your funds invested for? What is the purpose of your funds being invested? Answering these questions will ultimately help you in developing your strategy. Remember, there's no right or wrong strategy. However, strategies can be better or worse suited to an individual. Determining what will be your breakdown between cash and securities is a good start towards creating your investment strategy. So you might not want to have 100% of your funds invested into the stock market. You might want to have some of your funds in cash. So for an example, if you put $5,000 into your investment account, you might want to be 20% cash and 80% invested in stocks. So you'd have $1,000 in cash and $4,000 invested. $1,000 to deploy into the market if there were to be a crash, or perhaps you need the money. So in this instance, you would have 80% of your portfolio invested and 20% in cash. The breakdown of your asset allocation ultimately depends on your risk tolerance. A conservative investor may prefer to have 70% of his portfolio in fixed income and 30% in stocks. The reverse would be true for an aggressive investor, while a balanced investor would have a 50-50 split. If you are a high-risk investor with a long investment horizon, you may want to include small cap and growth investing in your portfolio. If you have a moderate risk tolerance and shorter investment horizon, you may be more suitable for value and income investing. If you have a low risk tolerance and short investment horizon, you may want to focus solely on income investing. For those looking for companies that aim to do no harm, you can add socially responsible assets to your portfolio with relative ease. It is also important to adapt to the investment strategy you are most comfortable with. Lastly, regardless of the strategy you try to adapt, always consider liquidity and trading volume. Now, we will discuss this in more detail within the next few chapters, and we'll take a look at why liquidity and volume is so important. And that's it for this module. We'll see you in the next.